Assalamu alaikum. This is Professor M.Hassan.Khan, and today we are going to cover chapter number 12 of Managerial Accounting and Control System. This chapter is going to be the last chapter for this course, and let's move toward the content of the uh, core chapter. In this chapter, we are going to cover at least nine topics, and each nine topics are very much important regarding to the course information. So regarding to the like we are going to discuss very much important things in this chapter. So before wasting time, just move toward the first topic, that is the financial statement analysis. So let's see that what is financial statement analysis all about. It says that the financial statement is the process of selecting, evaluating, and interpreting financial data in order to formulate an assessment of a company's past, present, and future financial condition and performance. So, what financial statement analysis is about? It it's like it says that it's the past, present, and future assessment of the company. What are the system? Over here we are selecting, evaluating, and interpreting financial data. We are just going to know do we mainly work on the financial data of past, present, and work for the future, for future predictions. So for all, this is all about financial statement analysis. Analysis means that we are just looking in the past, that what mistakes, what data of a past years tell to work on the present and for make the betterment of the future. So this is all about the analysis of the financial statement. Now next, that is objective of the ratio analysis. This was the financial analysis, and this is the objective of the ratio analysis. So standardize financial information for comparison. What are the objective of ratio analysis? It's like comparison, evaluate current operations, compare performance with past performance, compare performance with the past performance, and compare performance against other firms or industry. It's all about objectives. Study the efficiency of operations, and last, study the risks of operation. This is the objective. I have highlighted the few points, that is comparison, evaluating the current operations, past performance, comparing the performance against other firms or industries, efficiency operations, and the risk operation. This is all about the objectives of the ratio analysis. Use of the ratio analysis, that why the ratio analysis are used. So it's evaluate bank loans applications. It uses in the banking applications, evaluate customers credit with worthiness, assess potential merger candidate. Fourth is that analyze internal management control. And number fifth, that is analyze and compare investment opportunities. Where to use? It's used in all 1, 2, 3, 4, 5. Over here, it's the use of the ratio analysis. Now, the main important topic, that is intercompany. It's part of the basis of financial statement analysis. What is the intercompany? And over next, we're going to talk about intracompany. So, intercompany, like intercompany means, it's like Latin word. Inter means like Latin for between. It means that between. And inter from comparison means a comparison of the two or more similar business units competitors, with the objective of finding the comparative positions to improve the profitability and productivity of those business units. Thus, interfirm comparison is a tool used by the management of a company to compare its operating performance and financial results with those of similar companies engaged in the same industry. In short, that like interfirm intercompany is like it's mainly says that it's a comparison. Interfirm comparison means like comparison of two or more similar business. Like there are two companies, company A and company B. the comparison of A with with B is known as intercompany. The A company is doing the business of like it's the same business, like for example they're making beverages, like it's a Pepsi company. A company is a Pepsi and second company is B is a Coke company. So intercompany means that how much sale the company A, that is Pepsi company, may, and they both are comparing each other, uh, each uh, each other like sales, their revenue. So they're comparing each other. So because why this is intercompany, because they have the same business, and company A like it's also working on the beverages, and company B, Coke, it's also working on the beverages. So like they are working on the same product, they in same niche. So they they are doing the comparison. So this type of comparison is known as the intercompany comparison. Okay, I have explained with the help of example. Next, that is intracompany. And what intracompany? A Latin word intra means Latin for within, and intra from comparison means comparison of two or more departments or division of the same business. Like for example, there is a comparison uh, of like it's a comparison to, like for example, in previous intercompany we've talked about the like same business. Over here over here we just talk about the like two companies A and B. Over here intercompany, it's like a single company, A company. Okay, so what says that the comparison of two or more departments. So if you talk about a department, so the comparison is within in the company, within inside of company, like A department compare finance comparison with production comparison, like how much production was done in the comparison department, or like there's a comparison, there is like what progress and what you can say that uh, work progress and what are the results of two departments. So this type of for example, if you're doing these type of comparison, so this type of comparison is known as intra company comparison. Okay, next we have industry comparison. Over here we talk about two businesses, same business, A and B. Over here in intra we talk about within the company comparison. Over here in industry comparison we are talking about the whole business, like not two companies. Over here we are talking about more than two, three, four, or many other companies that have the same business. They have same business, that they are working on the same, like they are like for example, uh, same industry. If you talk about the banking sector, so in banking sector, if you talk about the banking sector of Pakistan, so there are a lot of banks. So in industry comparison means the, for example, a bank bank A is comparing, making comparison with other banks, with all many other banks. So there are like in Pakistan there are more than 20 to 30 banks. So a bank is making comparison with all 20 to 20 30 banks. So this type of comparison is known as the industry comparison. Okay. Next we are talking about the basis of financial statement analysis. Over here we are talking about tools of financial statement analysis. So these are a few tools. There are more tools. These are not only 8, but I have write the most important tools over here. So tools for the financial statement analysis. First of all, we have the ratio analysis. Second, we have vertical analysis. Third, we have horizontal analysis. Fourth, we have trend analysis, comparative analysis, comparative financial statements, cash flow analysis, break-even analysis, industry and benchmarking analysis. We are not going to talk about each and every analysis over here in deeply. I have just give the name and just tell you people that these are also the analysis. These are the tools for the financial analysis. Next, these are the types of ratios. Over here, we have ratios tab. First of all, we are going to talk about activity ratio, liquidity ratio, solvency ratio. Fourth, we have profitability ratio, and last but not the least, that is valuation ratio. So Let's move toward the activity ratio. Activity ratio means what it says over here. After over here, we're going to discuss each and every ratio in deep. So first we have the ratio analysis. The ratio measures. I have highlighted the most important part. So first, read activity ratio, also known as assets utilization ratio or operating efficiency ratio, measures how efficiently a company performs its daily tasks, such as managing its various assets, generally combine income statements, information in the numerators, and balance sheet information in the denominator. Activity ratio, what it says, evaluate operational efficiency, example inventory, turnover, account receivable, or turnover, account receivable turnover, inventory turnover. It says that efficiency over here, efficiency in putting assets investment in use. What assets are used in, like inventory, turnovers, account receivable. So it's mainly talk about the assets. Activity ratio shortly tell about the effectiveness in inputting assets investment in use, that how much assets were invested and how much they are using. So these all talk activity ratio. It's the word activity says that what type of activity, like assets are in use or an investment. So this thing tell about the asset investment. Second, we have liquidity ratio. What liquidity ratio is, over here we say we are just seeing this, the ability to meet the short term funding needs. So liquidity ratio means that short term, we are talking about the short term funding needs. So over here, liquidity ratio is how quickly a company can turn its current assets into cash, so it can meet its short-term obligation. Okay. Second definition, we are seeing that liquidity ratio measures a company's ability to meet the short-term obligation using its most liquid assets. They assess the firm's short-term financial health and its ability to convert asset into cash to cover liabilities. With the help of this word, cover the liabilities means this liquidity ratio mainly tells about, like, the company have like assets. So for any like if there is any use of the shortage of cash or something, so that current asset can be used as a cash. So liquidity ratio, it's like short term obligation, there is like a financial health and ability to convert asset into cash, like to meet its short term obligation. Okay, let's talk about, like, if there is any need of the cash, so these current assets can be converted into cash, like for short term for any short term usage. Okay, it's like that. Okay. Third, we are going to talk about the solvency ratio. What solvency ratio tells us, that's the ability to satisfy debt obligations long term. Over here in liquidity, we talk about the short terms. In solvency ratio, we talk about the long term. Okay, let's move it. Okay, these are some types of liquidity ratio. Okay, quick ratios, quick current ratio, quick ratio, cash ratio, defensive interval ratios, operating cash flow ratio, cash conversion cycle. Okay, sorry. So we were talking about the solvency ratio. What solvency ratio tells us about, it was telling over here, it's like we're talking about the long term obligation. Okay. Okay, over here we just read the definition. Solvency ratio measures company ability to satisfy the long-term obligation. Over here, it's tell about it's like to meet the company's short-term obligation. Over here with the definitions and with this word, it just satisfy the long-term obligation. For example, there's a need, so in long term, so solvency ratio is used to resolve this issue. They provide information relating to the relative amount of debt in a company structures and the adequacy of the earning and cash flow to cover interest expense and other fixed charge as they fall due. Okay, solvency ratio measures company ability to meet the long-term obligation and sustain operations over the long term. These ratios focus on assessing the company's financial structure, debt level, and the ability to generate sufficient cash flow to cover long-term debts and interest payments. Solvency ratios are critical for evaluating financial stability and the risks of insolvency. Okay, I just make this short. It's solvency ratio is used to make the long-term obligation. Simple as that. I've also highlighted the main important part in this definition. Uh, these were solvency ratios like debt level, debt servicing capacity, financial risk, long-term visibility. Okay, these are the parts of the solvency ratio. Okay, now let's move toward the profitability ratio. Okay, on fourth we are going to talk about the profitability ratio, like ability to keep a check on expenses and maximize profit. Profit means the word like check on the expenses and maximize profit. What it says over here, profitability ratio, a financial metric used to evaluate a company's ability to generate profit. It's clear that in over here we are going to talk about the profit. Okay, like ability to generate the profit. It's simple as that. Relative to its revenue, assets, equity, or other financial inputs, these ratios help stakeholders such as investors, creditors, and management assess the efficiency of the company in converting resource into earning. Uh, why this is very much important? So, if there is an investor with the help of profitability ratio, that investor will see the company progress, company current stability where the company is standing. So like it's mainly helps the stakeholders, investors, creditors, and management assess the efficiency of the company in converting the resources into earning. That what resources are there, and with the help of these resources, if they are these resources are converting into earnings, so profitability ratio is very much important, and it's mainly tell about how much profit company is going to make. Okay. Next, these are the types of simple profitability ratio: net profit margin, earning per share, EPS. We have also discussed this in our presentation. Gross profit margin, return ROE, return on equity, returns on assets, ROA, return on capital employed, ROCE, operating profit margin. So these are the part of the types of the profitability ratio. Next, but not the last but not the least, which was uh, like uh, valuation ratio, ownership of a specific claim. Valuation. So with the help of the word valuation, we have mainly understand the whole definition. Valuation ratio measures a quantity of an assets or flow that is associated with the ownership of a specified claim. Okay. Next, valuation ratio are used to assess a company financial health and market values. Next, valuation ratio measure the market's perceptions of company's value relative to its financial performance, earning, or book value. These ratios are primarily used by investors and analysts to determine whether a company's stock is overvalued, undervalued, or fairly priced compared to its peers or the overall markets. So, valuation ratio, where it helps, the most important line is over here. It's like company's stock is valued overvalued, the share value or the price of the share is overvalued, undervalued, or fairly priced. That's like up to the market. It's not overvalued, it's not undervalued. So valuation mainly tell about the value of the company, value of any asset, value of the uh, company growth. So this is all about valuation ratio. So this is the last topic, valuation ratio. Okay, I hope you just uh, have a very clear uh, point about each and everything, what value valuation ratio, profitability ratio, and solvency and liquidity ratio and activity ratio. Okay, thank you very much. I'm not going to make this video as longer, so till then, Allah Hafiz, take care, bye bye.